Welcome to the Investment Dive, brought to you by Corporate Capital Market Limited. Joining you today are your hosts, Amanda and Adrian.
Welcome back to the Deep Dive. Today we're going a bit deeper on debentures. We touched on them before.
Yeah.
You know, how they can sometimes offer higher returns than fixed deposits, maybe better diversification, liquidity.
Right.
But today our mission is really twofold. First, understand how they fit into, say, medium to long-term financial plans. And second, and this is crucial, we're unpacking 7 essential things you absolutely need to check before you even think about investing. Okay, let's unpack this. We're talking about a tool that could be, well, a cornerstone of your long-term financial stability.
Yeah, and it's interesting, isn't it, how often people might overlook something like debentures. I mean, in a world full of really complex stuff, understanding these structured benefits is, well, it's a shortcut to being properly informed, I think.
That makes sense.
What's fascinating here is how often people overlook the structured benefits of instruments like debentures when planning for significant life goals, you know?
Absolutely. And that leads right into their strength for those medium to long-term goals. I mean, we're not talking about super short-term things here, usually.
No.
Debentures often have a tenure of, what, 3 to 10 years?
Yeah.
Somewhere in that range?
Typically, yes. That's a common range.
Which gives you this predictable fixed stream of income over quite a long time. Think about, saving for a down payment on a house, maybe kids' education funding, or building up that retirement pot.
Those are big milestones.
Exactly. And here's a key advantage, especially with listed debentures, that fixed interest rate. If you think overall rates might drop in the future, locking in a higher rate now, that can mean better consistent returns for years.
It really secures things.
That kind of stability, that predictability, it's often missing from other investment types, wouldn't you say?
Oh, absolutely. And that predictability aspect, it's so important for long-term planning. If we connect this to the bigger picture, just being able to forecast your returns over, say, 5, 7, 10 years, that offers a profound sense of security for your financial roadmap.
Gives you confidence.
It does. It lets you plan more effectively. It raises an important question, though. How does this stability compare to other investment options you might be considering for those same goals?
Good point. Something for you, the listener, to think about: where does this fit in your long-term picture?
Exactly. Consider your own objectives.
Okay, so we've established the why. Why debentures can be useful for the long haul. Now let's get practical. Let's pivot to the how.
Right. The action steps.
This is where it gets really interesting.
Oh.
We're giving you the ultimate checklist. 7 key factors you must evaluate before you commit your hard-earned money. Let's start building this up.
And the very first step, honestly, it's fundamental. Non-negotiable, really.
Which is?
You have to read the prospectus.
Factor number 1. Read the prospectus. Seriously, don't just skim it. This isn't just some legal document to ignore. It's your roadmap.
It's your primary source of truth.
Exactly. It tells you everything vital.
Yeah.
The interest rate, obviously how often they pay you, the tenure, how long it lasts, what collateral, if any, is backing it up.
What they'll use the money for.
Right. How the company plans to use the funds. And sometimes you find specific promises or conditions in there, covenants, that protect you if things go sideways for the issuer. Don't skip this step.
Please don't. This document is your primary source of truth. Understanding it allows you to truly question and critically assess the offering. You wouldn't buy a car without looking under the hood, would you?
Ha, good analogy. Okay, moving on. Factor number 2, check the credit rating.
Ah, yes. The
Rating, this is like a quick health check, a critical indicator of risk. It's basically an expert opinion on how likely the company is to pay you back.
A shorthand assessment.
And you're generally looking for the top grades, right? Like AAA or AA plus. Those mean lower risk of default.
Generally, yes. Higher rating equals perceived lower risk.
But, okay, here's the thing. Sometimes you see lower rated ones offering much higher interest. Tempting, right?
Very tempting.
So what's the catch? What's the real trade-off there? How do you decide if that extra risk is actually worth it for your situation?
Well, that's the million-dollar question, isn't it? A higher rating usually means more stability, sure, but that lower-rated debenture with the juicy yield, that higher yield is essentially compensating you for a higher chance of default.
So you're being paid to take on more risk.
Precisely. The trap is underestimating that risk. You see the big number, but you might not fully internalize the increased possibility, maybe small, maybe not so small that you might not get all your money back.
Right.
So it really comes down to your own comfort level. This raises an important question. How do you assess your own risk tolerance before even looking at a rating? Are you okay with potentially losing some principal for that higher return?
That personal assessment is key. Okay, factor 3. Assess the issuer's fundamentals.
Beyond the rating.
Exactly. Remember, you're essentially lending money to this company. You're a creditor. So you need to be pretty confident they're, financially sound. Look at their profitability, their overall debt situation, how much do they owe already, and crucially, their cash flows. Are they actually generating cash?
You need to look under the corporate hood, so to speak.
Yeah, a company with a solid balance sheet, good profits, manageable debt. That's just a much safer bet, isn't it?
Absolutely. What's fascinating here is that you're becoming a stakeholder, in a way, in their financial stability. Their business health directly impacts your investment. Are they consistently making money? Can they handle their existing obligations?
Makes sense. Now, factor 4 is a bit more technical. Look at interest cover.
The interest coverage ratio, ICR.
What does that actually tell you?
Well, it's a really powerful ratio. It basically shows how easily the company can pay the interest on all its debt, including the debenture you're considering using its operating earnings, before taxes and interest.
So it's like a buffer? How much cushion do they have?
Exactly. Think of it as a margin of safety. You want to see a higher number here. What's considered good can vary by industry, but, seeing earnings cover interest payments multiple times over, say 2x, 3x or more, that's a strong positive sign.
And a low number would be a red flag.
It could be, yeah. It suggests less wiggle room if earnings dip.
Okay. And related to that, but slightly different, is factor 5. Evaluate debt servicing capacity.
Right. This goes a bit broader.
How so? Is it not just about paying the interest?
Well, interest is part of it, a big part. But debt servicing capacity looks at the bigger picture. Does the company have enough consistent cash flow coming in to comfortably meet both the regular interest payments over the years, and this is key, also repay the full principal amount when the debenture finally matures?
Okay. So it's not just about this year's interest, but the ability to pay everything back reliably over the entire term and at the end.
Precisely. If we connect this to the bigger picture, interest cover is more like a snapshot how things look right now, or based on recent earnings. Debt servicing capacity delves into the ongoing operational strength, the consistency of their cash generation. Is it reliable year after year? That's crucial for long-term reliability. You want to know they can handle the full obligation?
Got it. Consistency is key. All right, factor number 6. This one feels really important because it brings it back to the individual investor. Match with your goals.
Yes. Personal relevance.
I mean, a debenture could look great on paper, good rating, solid company, but it's only a good investment for you if it actually fits your life.
Absolutely.
You need to align the debenture's tenure, how long it lasts, and its risk level with your own financial goals and your timeline. Like the source said, are you saving for something 5 years away? Maybe a 5-year debenture fits perfectly.
Right. Or if your goal is much further out, maybe a longer tenure makes sense, assuming the risk profile is right for you.
It's about fitting the investment to your plan, not bending your plan to fit some investment you found.
Couldn't agree more. And this really prompts a self-reflection moment, doesn't it? This raises an important question. Have you clearly defined your financial goals and the timeline for achieving them? Because that clarity is your ultimate compass. Without it, how do you know if any investment is truly right?
So true. Get clear on your own stuff first. Okay, last one. Factor 7, the practical bit. Know the tax implications.
Taxes. Can't forget those.
Yeah, and unfortunately, the interest income you get from debentures, it's generally taxable.
In most places, yes. It's treated as income.
So you need to factor that in when you're calculating your actual take-home return. A 7% interest rate isn't really 7% in your pocket after tax.
Correct. You need to understand what your marginal tax rate is and how that impacts the net return.
So the advice is plan for it. Or even better, maybe get some professional advice just to understand how it fits into your overall tax situation.
Definitely wise, especially if you're unsure. It avoids surprises later on.
Okay, so let's recap quickly. The 7 factors. Read the prospectus, check the credit rating, assess the issuer's fundamentals, look at interest cover, evaluate debt servicing capacity, match it with your goals, and know the tax implications.
That's the checklist.
So there you have it. By doing your homework, by diligently going through these steps, you can make a much more informed, much more confident decision about whether a specific debenture is right for you. That's really our goal with these deep dives. Cut through the jargon, give you the tools.
Right. And what's truly fascinating here, I think, is that while these steps might seem straightforward, maybe even a bit tedious.
Huh. Doing homework often is.
True. But the discipline of actually applying them consistently, that transforms investing from something that feels like a gamble into a calculated strategic act. You move from being passive to being an active, informed decision maker.
That's a powerful shift.
It really is. And it leads to a final thought, perhaps. This raises an important question for you to consider. How will applying these principles, this kind of structured thinking, change your approach to your next financial decision, whatever it might be?
Food for thought indeed. Well, thank you for joining us on this deep dive into debentures. We hope it's armed you with some useful insights.
Hope so too.
We look forward to having you with us for our next exploration. Thanks for listening.